it all goes back to the question on is there a recession on the horizon? And I do believe a recession is likely in the next few quarters.
The market is pricing in what he would call a shallow recession. It is pricing in a downturn.
In today's world, it's easy to feel like you're being shot out of a cannon. When it comes to the economy, there's so much stuff coming at you from all directions, and it can be tough to navigate the market. In today's video, we're going to cover Raoul Pal insights on what's happening in the market today. But before we get into the video, be sure to subscribe to my channel if you're new here, and don't forget to tighten your seatbelt, as it's going to be one bumpy road. Stay tuned to the video as Raoul Pal shares his insight on why a full recession could be touching our feet soon. Raoul Pal starts with discussing the Financial Condition Index chart, which he believes is one of the best indicators we've got. And it shows financial conditions tightened, leading to a downturn in the economy. Let's hear him out to know more details.
There is a lot going on, and it's very noisy for a lot of people. So I'll see if I can distill my thoughts down. So I'm going to walk you through in a bit more detail now where we are now. So the first chart that I want to show is the Financial Conditions Index, which is basically a combination of commodity prices, the rate of change of rates, and the rate of change of the dollar. That against the ISM, which is the Purchasing Managers Survey, which is a good guide to the business cycle, is a 9-month lead. It's one of the best indicators we've got. And what it shows is financial conditions tightened by the fastest rate in history. And that is leading us to expect that the economy is going to have a Wile E. Coyote moment where the ISM goes from 53 down to, let's say, 35. 35 is a severe, sharp recession. Now, that indicator is already bouncing as bond yields are starting to come off. And I'll come on to this a bit in a minute, and oil's come off a little bit. And it kind of suggests we're going to see a sharp recession. Now, last time I spoke about previous recessions and times that have looked similar. The one I've been following the most is 1973, 1974.
Raoul Pal suggests that we're going to have a severe, sharp recession, and he also believes that this all seems very familiar to 1973 and 74. Let's discuss how they both look so similar. So, the oil crisis of 1973, or first oil crisis, occurred after Arab members of OPEC decided to quadruple the price of oil. They proclaimed an oil embargo. They prohibited oil exports to the United States and Western Europe, which caused the oil prices to increase to around $12 per barrel. Now, just like that, the Russian and Ukraine war has deeply affected oil this time around as well. What started with $76.08 this year reached over $100. The Brent crude global benchmark rose 2.69% to $103.79 a barrel on Monday, set for its biggest one-day rise since early July. Monday's rise in oil prices reverses some of last week's losses on the back of fears of recession. Back then and now, there was a supply shock. The price of oil was screaming higher. The economy collapsed, and the market collapsed. In the last phase, roughly where we are now, ISM actually went from 56 to 30 in 4 months, which was the fastest collapse in history of the ISM. And that was caused by the supply shock in oil. Let's hear more of what Raoul Pal has to share.
I think we got a similar setup. We also had something very similar after World War II, 1947. We had, like COVID, the whole world had been shut down. You reopen it, not enough supply of stuff, everybody's back into the civilian labor force, and the price of goods explodes. Inflation goes up to 20%. 2 years later, and economic growth collapses, the ISM goes down to 30, similar kind of setup, and the equity market collapses with it. The other one was 2018. We also saw a rise in commodity prices. We also saw financial conditions tightening massively because the Fed had been tightening and quantitative tightening had been going on, and the ISM again collapsed. So, and the equity market went down with it. The Fed pivoted. In all circumstances, the Fed actually changed very fast. They didn't change when inflation rolled over, which is the narrative. They have to see inflation roll over. It actually changes when the ISM crosses 50. I went back and looked at every single time since 1967 that the ISM crosses 50, and the Fed cut every single one except 2016, where they paused. So it tells you that the economy takes over all precedent when when it comes to the things they monitor, because then unemployment becomes more important, because unemployment means voters and other stuff, even recession.
If you look at every U.S. recession and economic downturn, well, since 1967, according to Raoul Pal, you'll see two things that always happen. Whenever ISM crosses 50, Fed always pivots. Now it means that ISM is a more crucial indicator than CPI. Right. Now, for most Americans, when do you feel a recession? It's when you start worrying about your job, when prices go up, people spend less money, which means businesses make fewer profits and lay off workers. Don't loosen your seatbelts. We've not hit the end of the road yet. Ahead, Raoul Pal will be discussing the market and recession in more detail. He's going to provide his insights and observations on the current state of the economy and what he believes will happen in the future. Stay tuned for more information, and be sure to give a big thumbs up. Let's hear him out now.
So where are the markets? Where are we pricing in other stuff? So that's 9-month lead. So the next chart to bring up is the ISM new orders less inventories. That's a 3-month lead, and that suggests the ISM in the next 3 months is going to 45, which is a full recession. So it's saying we'll be in a full recession within 3 months. Okay, that's starting to get interesting for us. Now, the issue here is inventories. So the next chart is the chart of wholesale inventories of durable goods. I mean, that chart is shocking. And there's different types of inventories, and most of them show something similar, is that inventories have gone up because everybody stocked because of the supply issue. They overstocked, and now demand has gone. Demand has gone because the financial conditions have tightened, and inflation has taken away discretionary spending. So now everybody's got too much stock. Now, building of inventories is positive for GDP in the equation for GDP, and releasing inventories is negative. Normally, to get rid of inventories, you lower prices too. So that starts to get interesting to say, if they're going to have to clear all this inventory, they're probably going to have to lower prices.
So according to Raoul Pal, full recession could be reaching our footsteps very soon, especially if you see these ISM charts. Now inventories are piling up, demand has gone, prices are rising, financial conditions are tightened. So how will a normal American deal with all these? It really feels like being shot out of a cannon, doesn't it? What are your thoughts on all these things going around? Let me know your thoughts in the comments below. I'll see you all in my next video. To always stay updated, be sure to hit that bell icon. Also, don't forget to subscribe and like. Adios.